as the market was rallying, there was a lot of attention paid to what we call the FAANG stocks. And you can debate exactly what the components are in that group, but some varying consensus is Facebook, Apple, Amazon, Netflix, and Google, being the G, even though it's really Alphabet. But those stocks were really major outperformers, and I don't have to go too much into the details of why. And yet now we're seeing some real underperformance from a lot of those names. What causes this? Part of it was I tend to get very concerned when leadership in a market narrows, and we really started to see that. And you can go back through history. There's plenty of historical precedent for this. There was the Nifty 50 back in the 60s and 70s. There was the internet bubble, 99, 2000. There were the financial stocks, which more or less did the same thing in 2007, 2008. It tends not to end well for the market overall when it's being led by ever-narrowing groups of stocks, and that's really what we saw. Now, let me be careful here and not say that I'm not at this moment looking for a repeat of the events of any of those debacles, but the lesson here is that when you start to see very narrowing leadership, it's a danger sign, because what happens is performance chasers tend to crowd into those same names, and eventually they hit a pinnacle where who's the marginal buyer? And so you get a market downturn, and those are the same names that people have to raise cash in. A big problem when you have a market downturn is, particularly those who are trading on margin, need to sell their winners to pay off margin calls, or it's easier to sell the stuff that's been performing well rather than sell the stuff that's in the tank, and that's part of the underperformance. I think the market really has had a psychological shift here, and we'll see whether it's temporary or whether it's longer term. And I think through most of 2018 and even the period prior, but let's use 2018, the market was basically willing to pay any price for the growth that these companies promised. And let's be real here. These companies have been growing at tremendous rates, whether it's top line, bottom line, or both. And so there really is a case for them having a premium valuation. But every valuation has its limits. Every valuation is stretched at some point if it gets too popular. Let's take Amazon, for example, where the stock was still up 50% even after some of this pullback. But one of the commentaries that I'd heard was very interesting, and it was basically after the stock had rallied after Microsoft had great cloud results, and then sold off on its own results, and then sold off again when IBM bought into Red Hat, basically being another cloud competitor potentially. But one of the comments that someone made after Amazon's earnings release was, in a few years I can see this company earning $30 a share. Okay, $30 a share on a $1,500 stock is 50 times earnings. That's huge. So what that tells me is that people are still paying a very, very high price for some of these stocks. It makes me a little nervous, whether or not the market can continue this desire for the outsized growth that these companies promise. I was always raised in a world where you wanted a PEG of about 1, where the PE divided by the growth rate should be about 1. Something higher than that means it was kind of overvalued. Something lower than that means it's potentially undervalued. It's a very rough measure. It should be a starting point for your analysis, not necessarily the ending point. But what we started to see with some of these companies is that the PEG was multiples, and that's kind of telling that the market is probably excessively valuing their prospects. And so now market's starting to see some of the warts in these companies. Facebook has been a great grower, but their basic product seems to be stagnating somewhat. Instagram has been really providing a lot of the growth there, but now they've got security challenges and censorship problems, and it's probably going to be more costly for them just to do their basic business. And one has to wonder where the growth is coming from as people sort of tire of sponsored posts. We'll see. But all of a sudden, people are looking not necessarily at the glass half full all the time or fully full all the time. People are starting to look askance at some of the problems. Look at Netflix. Their top line earnings are great. People are continuing to consume their product. But if you look through the numbers, their cash flow is terrible. And the company has a continual need to raise money. They've been tending to do it through straight debt financing, which appears less dilutive to equity investors. But don't kid yourself. All refinancing is somewhat dilutive to investors. If a company's equity is assets minus liabilities, and you increase the liabilities, then therefore the level of equity is diminished somewhat. It's just a simple mathematics equation. And so people are starting to worry about the tremendous cash flow needs that Netflix has. Maybe not necessarily quite Tesla-like in terms of its cash flow needs, but boy, they do not show a good picture if you look at a graph of their cash flow. So what this is telling me is you've had a psychological change. And it's way too early to know whether this is the beginning of a trend or just a blip in a trend. But I think it's very telling, and I think it's a good wake-up sign to investors to never lose sight of the fact that even behind the best of companies on the surface, there's always something underneath. And if the market is willfully ignoring the negatives, sometimes that's a great thing, and it can be a wonderful thing if you're riding a winning stock higher. But never lose sight of that, and don't be surprised if when you've been riding one of these winners way up, that's the kind of thing that the market turns around and punishes on the way down. It's not necessarily even because it wants to punish them. Sometimes it does it just because it has to. Again, as I mentioned, with if you're caught in a bad margin situation, you sell what you can, not what you have. Sell what you can, not what you have to. But so I would now start to think of the FAANG stocks individually. I think that's always a safer idea anyway. But take a look and see what they got. What do you think of the Facebook situation going forward? Is Amazon overvalued? If they're starting to really show bottom line numbers. What happens if Amazon starts to be valued like a conventional company? Apple has been this profit juggernaut. Does that continue? If yes, then it's a good buy. If not, then not necessarily. Netflix, we went over, and Google continues. Again, they've had this great run. They seem to be the least controversial of the names that I mentioned. But like everything else, it's hard to avoid the basic market activity. So be careful with your FAANGs. I've been saying that before, but now maybe after a little bit of a downside, it's time for a little bit of two-sided analysis rather than just chasing and riding a winner.